What's up, everyone? This is Kirk here. I'm just showing you my kids literally, like, you guys don't understand. I don't think I've ever showed you guys this in the office, but my kids, like, they're like wild hyenas. They just came through here and absolutely made a disaster of my office. But they do that all the time. But I like actually having them here. It's good. It's fun. So I wish it was always clean, but every time I clean it, they just seem to totally destroy it anyway. So today what we're going to be talking about is options trading loops. And I wanted to use this quick little screenshot here. So I'll show you this real quick and then we'll talk about it a little bit more. But what we're going to be talking about is this, the options trading loop. Just the idea that you sell to open, buy to close, buy to open, sell to close, but you have to complete this loop as part of your trade. I'll go through each of these steps here just really quickly and kind of help you understand this if you're new to options trading. And then at the end, what I want to do is go through some analogies with home builders and with insurance. And you're probably thinking to yourself, what in the world does home builders or insurance have to do with options trading? But I promise you'll understand what we're talking about here as we go through this. So first, let's start with a stock. And I just want to go through the idea of using a stock with this trading loop because it affects all securities. It's all investments. It doesn't matter what it is. It's not just for options, but I want to start to build up towards this options model that we're talking about because I think people have a hard time understanding how they can sell an option contract that they don't even own and then buy it back later. And like, how does that even work? I don't even own it. How can I sell it first, right? So if you have that question, say, yep, that's me in the comments real quick or something. So let's talk about stocks first, right? So with a stock, it's very easy. And what most people do is they do it one directional. So they buy a stock and then they own shares. So they physically collect the shares in their brokerage account. And then that allows them later to sell the position to close. So they buy to open the position and then later they sell the position to close the loop and remove the risk. I buy the stock from somebody in the market and hopefully it goes up in value. And then later I sell the stock and close the position. We all get that, right? Very easy. Now on the stock side, you can actually do the reverse, which starts to get a little bit tricky. So with stock, if the brokers allow and if there's float enough to be able to borrow stock on margin, what you can actually do is you can sell stock you don't even own. Yes, that's true. That's possible. So this is what people do when it's called short selling. And what they do is they sell stock they don't even own, anticipating that hopefully they can buy the stock back in at a lower price later on. Now, what actually happens is that they physically borrow shares from the brokerage or the exchange, and they borrow those shares with the understanding that they have to give them back in the future, right? So it's a little bit different. So when you buy stock, you are actually getting the stock and then you give it back in the future whenever you want. When you borrow shares to sell them in the open market, well, you can't just borrow the shares, sell them and just say, peace, I'm out. Like you can't walk out and say, peace, I'm done, right? You've got to complete the trading loop. So if you sell something to someone, you should have to deliver those shares back to the brokerage at some point in the future. Now, your hope is that you deliver them back to the broker at a lower price, right? So if I borrow, let's say, shares of whatever, USO for $15 a piece, right? I borrow shares of USO, I sell them directly to somebody else for $15. Well, the most money I'm going to collect from that is $15. So if I'm going to complete the trading loop, because remember, the broker, they need their shares. You borrowed shares, so you got to give shares back from somebody else, right? That means I've got to go out and buy shares from somebody else, hopefully for less than $15. So that's how short sellers make money. They sell at higher prices and they buy back in at lower prices. Now, the whole idea about options trading is the exact same thing. We have to close the loop when we trade options. And what that loop is the buy to sell, buy to close, or sell to open, sell to close loop that we have to do. So again, let's go through this on the whiteboard here because I think this is important. So when you have any option position, you can choose if you want to sell the option position to open or if you want to buy the option position to open. Now, what most people do is they do this. They understand, okay, buy an option contract and then following the loop down and around. That means that to make money, they have to sell the contract later on to somebody else. Now, what we choose to do at Option Alpha is do things a little bit differently. Instead of buying option contracts, we choose to sell them first to open. Yes, this means that we are short contracts. It means that we have an obligation at some point to let those contracts either expire worthless or for somebody else to buy them from us. We have to buy them back to close and basically sell them to somebody else. So that completes the option selling loop. So if we follow this loop all the way back around, the only choice that we have then is to buy to close. And this is just a whole loop that we have. So people are doing this all day. So I don't want to get you guys dizzy, so I'll stop doing that. But that's what people are doing literally all day. They're selling to open, in our case as an option seller. I'm selling a contract to somebody with the obligation that I have to close that loop somehow by buying back the contract, hopefully at a lower price. And then that person, they're buying the contract from me, hoping to sell it to somebody at a higher price later on. So it's the same thing, it's just different mechanics, like who's on different sides, right? So hopefully that makes sense for those of you who are guys are in here right now. Just let me know with hearts or love or whatever you guys want to do. Smiley faces, thumbs up in the comments. So I want to use two analogies here, and I think this will help out in just kind of understanding how is this even possible, because it happens all over the place. It's not just the options market. So the first one I want to talk about is home builders. Yes, home builders. So think about this. If somebody comes to you and they want to build you a house, a brand new house, so they're a contractor, they're a home builder, they want to build you a house. You guys work together, you figure out the details of the house. You want it to be 4 bedrooms, 3 baths, whatever the case is, right? But then what they do is they figure out a price. So the home builder might come to you and he might say, okay, to build your house is going to cost $200,000. And so now what he has done, even though you don't know that it's happened, is he has sold you your home for $200,000, right? The home isn't built. It's not done. He's just telling you, hey, it's going to cost $200,000. So I'm going to need to collect $200,000 from you at some point, however we distribute, the cash, if it's a loan, if it's a line of credit, cash, whatever it is, cattle, I don't know. Like, I'm going to collect $200,000 from you to build this house. Now, he is an option seller. He just doesn't even know it, because what he has to do to complete the trading loop is do what? He's got to deliver a house. So his goal in life is to build the house for less than $200, including materials and labor and permits. And his profit, he wants to build the house for less than $200,000. Does that make sense, right? It happens all over the place. It happens in every market around the world. People are selling stuff that they don't even own yet, don't physically have, with the understanding that they have to deliver it and hoping that they deliver it for less of a price. So this is that same trading loop that we talked about. He's selling you a house, collecting money up front. He's trying to deliver the product or the house for less than $200,000. So what happens when he delivers the house, but it costs him $205,000? Well, guess what? He eats that loss. That's a loss for him, right? He promised he would sell you the house for $200,000. If it costs him $205,000 to build it, that's on him, right? He still has to deliver the house. So that's how you would lose in an option selling scenario, right? That's how we lose in option selling. If we sell something for $200, but we have to buy it back for $300, we lost that difference, right? We still have to buy back the contract. We're not removed from that obligation. We still got to deliver the house. We're just hoping to, basically build it for less. So the other example here that I want to describe is insurance. So insurance works the same way. In fact, it's very much the same business model as options trading. And in insurance, what insurance companies do is you go to them, and it's funny, like if you actually think about how this stuff works, it's crazy. You go to the insurance company and you say, look, I need insurance. I need coverage, right? You got to cover me in case I get in a car accident or my house burns down or I die, like whatever insurance you get. And so they say, okay, no problem. We'll cover you for a year, maybe $1 million policy. And what we need up front is we need $1,000 from you up front. So what they've done is they've sold an option contract to you. So you have been the option buyer. You buy a contract from them, right? An insurance contract. That's why we go out and we buy insurance, right? We pay a premium to buy insurance. That premium goes to the insurance company. And the insurance company now has the obligation to fulfill that requirement unless expiration comes first. Fulfill that requirement during that time period, right? So it's the same thing as like home building. They're collecting money up front and they've got to fulfill that requirement. Now, in the case of insurance, which is the craziest thing in the world, if you don't die, get into a car accident, wreck your car, they don't have to pay out anything, right? They collected all that premium up front in advance, which is the same daggone thing that happens in options trading. If you sell an option contract and that contract goes down in value and expires out of the money, you don't have to do anything. You don't have to buy back the contract. There's no contract. It just expires worthless. It's the same thing that happens in insurance. It's crazy that that happens, but it's basically the same business model. It's exactly why, and I say this all the time, it's exactly why Warren Buffett's biggest business, his most loved and cherished business, is insurance. And it's the same reason why Warren Buffett sells billions of dollars of options contracts and publicly discloses it in his 10Ks and 10Qs, which is all out there for the world to see, because he understands that this premium collection is the model to generate as much stable, consistent cash flow as humanly possible. So hopefully it helps out. Hopefully this whole discussion about trading loops today was hopefully informative and helped out and kind of maybe clarified some things if you were a little bit confused, if you're a new trader. If you do have questions though, let me know. Add them in the comments right below. And definitely let me know if you guys have any other topics that you want me to cover. Tomorrow, I think what we're going to be covering here, I just got to look on my computer and see, because I think tomorrow is going to be going. Yeah, tomorrow we're covering inverted positions versus adding new spreads. So what goes first? Do we invert the position if we have a position that needs to potentially go inverted, or do we just add a spread potentially on one side? And how do we deal with that? So that's the topic for tomorrow. As always, if you guys have any questions, let me know. And until next time, happy trading.